A lot of people are on vacation. The volume is low. People want to take some profits off the top before the end of the year. But having said all that, with GDP growth at over 4% annualized for the last quarter that we can account for now, with all the news, all the bad news from the Fed out on the table, that this rally will continue strong for the next couple of weeks. Alan.
You know, there's a good chance it will, David. You know, I think it's really teed up, you know, as far as it digested the tapering, you know, no problem. You know, we had great multiple expansion for 2013. And 2014, starting with the first quarter, David, we're going to need to see, you know, some growth. And we're going to need some follow-up to that expansion because that multiple expansion is based on earnings growth. And if we don't see it, we could, you know, see a pullback. But I think until then, we're going to see some strength. We're going to see investors riding the wave like we have been doing. And, you know, it's prudent to take some profits in the high flyers, but there's still some bargains out there. So it's really an ideal market, but be careful as we go in and if we go higher into 2014.
Alan, you're driving me crazy. You're saying take some profits, but we're riding the wave. We got to be cautious, but things are still looking good. Let me then throw it to Joe, and I need to force you guys to pinpoint a little bit more and take a side here. Neil Cavuto was always the one to say, don't let people come on and say, on the other hand. Where do you go here, Joe, with looking forward? Gigantic trades like the NASDAQ up 30% year to date often don't repeat themselves. So what is the change that you're making with your money and your clients' money?
Well, Liz, we think the best sector in the market next year is actually to invest in pipeline companies. One of the things that the Fed said was that they're going to hold short-term rates basically at zero for a very long period of time. Folks still need income in their portfolios, and the energy sector is probably the most dynamic and an interesting part of the U.S. economy today. So you can move over into the pipeline companies, which is probably the safest part of the whole energy complex. Invest in securities that are giving you yields from 5 to 8%, good growth characteristics. We've given you three, as I refer to them as holiday gifts for you and for the viewers today. Three really strong companies that we could all invest in and make some nice income during 2014.
All right, before we get into the details of individual stocks, Mark Sebastian, what do you make of that play? Guaranteed that there is nowhere in the economy where there's more excitement, more production going on than the energy sector right now. You look at some states like North Dakota with an unemployment rate of 0 because of all that. Is that where you should be putting your money, finding the right play? Maybe it's pipelines, maybe it's something else in the energy sector?
Yeah, I like utilities, actually. If you look at the major pieces of the S&P 500, the big underperformer this year was the utilities.
Yeah, I was going to say utilities have been beaten every which way since the past year.
Yeah, they've been crushing it because people were assuming the 10-year was going to go to 3.5%, 4%. Right. They were assuming we're going to have an inflation. That's not happening. I think the utilities look like a real scoop. They have high dividends. They've been, definitely been the underperformer. I think going into 2014, if you had to pick a sector, I really like the utilities to potentially be a leader for 2014.
Okay, now we go back to Alan because I do like your stock picks. I think they're interesting, especially since you're not telling our viewers to buy at the highs. Nuance Technologies. This, in a way, is an Apple Halo play, is it not? Alan?
Yeah, Apple and Icon, Liz, and Apple and Icon. It's a situation where the stock is down. They're going into a recurring revenue format as opposed to just billing out per sale. And again, the stock's hitting new lows. Icon bought at $18, $19, bought some more just this past week at these levels. And that's what I mean. Don't chase the companies hitting new highs that are trading at astronomical multiples, but buy these bargains, and you can still participate or ride the wave, yet not take the risk. And that's what I meant by my opening statement.
Got it.
And if Icon's buying in, he must know something. Joe, let me go to you. Throw out a contrarian argument because we can't ignore these tremendous growth figures that came out today. I'm just wondering, I know everybody's focused on Obamacare and the disaster, and it's 1/6 of the economy, et cetera. However, the rollout of Obamacare has been so bad, so disastrous, even the president's men have to admit it. The president just did earlier this hour. Is it conceivable that the market is thinking, okay, there's no way this thing is going to stand. All of the waste of money that we thought was going to be wasted in our economy for Obamacare is not going to happen because everybody's woken up to the fact it's not going to work. It's going to change in the next election. Is that probably a positive sign, the fact that this disaster has been so obviously bad?
You know, David, I think investors really, for the most part, have kind of shifted their focus away from Obamacare. I think it's really hard to figure out exactly how things are going to play out with the Affordable Care Act over the next 12 months with the coming election next year. And I really think investors are more looking at the fact that the backdrop for common stocks is pretty darn positive. When you've got consistent, moderate, but consistent growth in the economy and low inflation, the Fed just told us they're going to remain very accommodative, low fixed income yields, and operating earnings in the S&P 500. The growth rate picked up during 2013 as opposed to being flat during 2012. So that backdrop is really very positive for the stock market. The issue with the stock market is, and Liz, I don't mean to be doing a one hand this hand, one hand the other hand here, but the issue is that price earnings ratios are up quite a bit. The market is discounting all that good news. We've seen the price earnings ratio go from 13.3 times to just under 18 times. So I think stocks are still the place to be, but I think you got to be careful, and it's going to be much more of a stock picker's market in 2014 than it might have been over the last couple of years.
All right, that's fine. And Alan, you tell me what is the number one and two things that you must see in a stock before you'll commit money to it.
Well, I want to see, good cash flow, trading at historical lows, and good management for number one. And then number two, there's got to be some type of catalyst, whether it's income and that income will increase, or some corporate event like with Nuance we have Icon and that potential. With our other pick, Quality Systems. It's actually Obama, healthcare play because they do medical technology and they're going to help the healthcare providers and the insurance companies go paperless. So, that's what we look for in the market and in a recommendation.
It's the weekend before Christmas. Gentlemen, have a great weekend. Thank you very much. Joe Keating, Alan, Lancz, Mark. I can hear that things are really heating up in the S&P pits. We'll get back to you for the close in just a couple of minutes. Well, 2013.